And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And welcome to the show this morning. Of course, it's Hump Day, which means that Danny Ratliff will join me this morning. We've got a lot of things to talk about. We're going to talk about tech stocks, in particular, this recent surge back in tech stocks. What does it mean, if anything? We'll get into that. Before we get into that, just kind of our hearts and prayers go out to all of you in Florida right now. Hurricane Milton is expected to make landfall tonight. Hurricane Category 5. Flooding is going to be terrible. There are hurricanes and then there are hurricanes, and this is the latter. And growing up, I've been through some pretty devastating hurricanes, and until you've experienced having your house flooded and losing everything that you own, just kind of watching it wash away. It's very traumatic, and is certainly something that you wish on nobody to ever happen. And so again, our hearts and prayers out to all of you in Florida, particularly if you're watching the show. Please be safe, be careful. I have a lot of friends in Florida. That have never evacuated. They're evacuating for this one. So again, just a moment of concern. When we were growing up, the first time we went through a hurricane and the house flooded, we had carpet in our house. I told you before, I grew up in Lake Jackson. It's a little small town. At that time, it was really small. It was only like 20,000 people. Everybody in that town worked for Dow Chemical. It was a plant town. And so all the houses were very small, 1,100 square feet, that type of thing. Our house was 3-bedroom, 1.5 bath, very small house. It had carpet in it. And so the first time we got flooded was with Hurricane Carla, and which was a really devastating hurricane that hit. And we had this big tree that was a big oak tree, and it grew up right behind. It literally was like 5 feet from the back of the house. And the hurricane spun that oak tree out of the ground and laid it horizontally down by the house. It didn't hit the house, fortunately, but laid it right down by the house. But the house completely flooded. We were about 4 feet underwater in the house and had carpet in the house. So after that, my dad swore he would never go through that again. So he tore all the carpet out of the house. He tiled the entire house and then tiled up the house about a foot on every wall. So when it flooded, it was like a pool. And we just sweep the house out. So, but we got flooded 4 times. Before I left. In fact, I left, I can't remember the name of the hurricane. So we got flooded we had a hurricane hit in 1983. I have maybe Alicia. I have to go back and look at it was Alicia in 83. We got hit by Hurricane Alicia, and I was getting ready to leave for college, and we lost power, water's coming up the driveway. I'm packing my car for college. I was determined to leave Lake Jackson and never go back again, but I literally packed and drove out of town to college in the middle of that hurricane. So,
and that was just a Cat 3 storm.
She was only Cat 3. Then the house did not flood on that one, but it's been through. Anyway, the moral of the story is that if you've ever been through that, it's a terrible experience. And certainly, if you have friends or family in Florida, be sure and pray for them right now, because this is going to be a bad one. So, okay. Having said all that, we'll get back to the show now. A couple of things. This morning, I woke up late, slept right through my alarm. I told you I was cranky yesterday. Slept right through my alarm this morning. My wife woke me up, and so I was in the middle of this dream when she woke me up of the alien armada coming to Earth. My wife's ex-husband's new wife is a flat earther. She believes the earth is flat. And so in my dream, the alien armada is coming to explain to her that the earth is actually round. So
Nice.
Anyway, I woke up late, so here I am.
I bet you Richard could do a script treatment of that one.
Exactly. I'm thinking more like Attack from Mars. Or Mars Attacks, that was the one. All right, a couple of things. What you need to know before the bell this morning. I know you're all probably going, please, get to something important. Here's what you need to know before the bell this morning. A lot of videos running around right now talking about this surge in interest rates and how interest rates are now going higher. The era of low interest rates is over. And we've been through all of this before, and you know, the economic data simply can't support higher rates. We just don't have the economic growth for it. We don't have the underlying infrastructure for it. We have too much debt to support higher rates. So interest rates have to come lower. Doesn't mean, though, that rates are going to come straight down when they start going lower. And again, this is something we've talked about repeatedly. We've written about it numerous times. I just wrote an article recently on the website talking about James Grant's views on interest rates and why he's likely incorrect. It's just because the economic data doesn't support higher rates. It doesn't mean that rates can't go up. And we talked about this 2 days before the FOMC meeting, and that when the FOMC cut rates, that would be a buy the rumor, sell the news moment for bonds. And that's exactly what happened, and bonds have sold off, and we've now had this move up in yields. And of course, that strong employment report on Friday caused a bit of a knee-jerk reaction in yields, and so we've pushed up here a bit. Technically, the reason that we said you couldn't buy bonds back over here when rates were coming down and everybody was dying to get into bonds at this point was because they were extremely oversold. Now, this is a chart of interest rates, okay? So this is the 10-year Treasury yield. This is the inverse of bonds that's going on. So when you're down at the bottom, you're extremely overbought on rates. At the top, you're extremely oversold. So we were extremely overbought on bonds at that point, oversold on rates. And we said, this is why you can't buy bonds. They're going to reverse for some reason. We said specifically back then, something that prints out at a higher rate of inflation or expected to lead to higher inflation, i.e. a strong employment report, would cause that reversal in rates, which is exactly what happened. Importantly now, though, as you know, we've seen, we are now more overbought on rates than we have been in a very long time. In fact, very rarely do you get this overbought on rates without having rates reverse and go back down. So again, if you've been looking for an opportunity to add bonds to your portfolio, we're getting there. We're starting to push up into important moving averages here, which are resistance. We're extremely overbought. We're still on currently a sell signal. We haven't reversed that just yet. That won't take long to reverse once we start to get a reversal in rates for whatever reason. But again, just from a technical basis alone, yields are going to reverse here and they're going to come back down. Now, does that mean that rates are going to reverse here and go to 1%? No, that's not what that means. But we can't sustain 4% rates for very long because it starts to impact economic growth. That refi surge you saw, for instance, in the market, can't sustain that for very long. Right now, the NFIB is borrowing, just their survey came out yesterday, their borrowing rates for small business loans are running near 8%. That's very high for small businesses. So again, that's going to impede things like capital expenditures, which we're already starting to see a big deterioration in CapEx spending, which supports economic growth. So again, high rates are economically deleterious, which is going to lead to slower rates of economic growth. As economic growth rates slow, i.e. so do inflation and interest rates, because they're all tied together. They're all important. They all flow together. In fact, there's a very high correlation between the Fed funds rate and lending rates by banks, which is where rates are tied to. So again, all of this tells you continually that as the Fed cuts rates, rates are going to come down, and you want to use opportunities where you get extremely oversold condition in bonds. That's your opportunity to add bonds to your portfolio. But again, got to kind of set aside all this hysteria about higher rates and they're going to go higher for longer. Just simply economically can't sustain it. That's what you need to know before the bell this morning. All right, when we come back, we'll pick up with Danny Ratliff. Got a lot of stuff to get into. We'll talk about tech stocks, big surge back in tech stocks. What does it mean? Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Medicare open enrollment starts October 15th. If you need Medicare insurance coverage, RIA Advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the Insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Danny Ratliff joining me as well. So over the last couple of days in particular, actually not last couple of days, but last couple of weeks, very quietly, mega cap stocks have been making a return. NVIDIA's trading back close to its all-time highs now. Yesterday, we saw in particular, it was kind of an interesting day because all the big tech stocks across the board rallied fairly strongly. In fact, it was kind of almost back to the old days. Energy underperformed. All the mega caps were outperforming yesterday as money was kind of flowing back into highly liquid, mega cap positions. Again, this is support. This is what you would expect to see in a continuation of a bull market. And, as we've kind of talked about over the last few days, we are continuing to consolidate at this very high level in the markets. In fact, we're very close to all-time highs. Day before yesterday, we had that, the market sold off, and it's like, oh my gosh, what's going on here? We're getting this kind of sell-off across the markets. And yesterday, we completely reversed all that. Now we're back at the top of this consolidation trading range that we're in. And so technically, everything remains fine within the markets. The one thing we're still dealing with is this convergence of price, where, as we talked about in this past weekend's newsletter, if you haven't read it yet, it's on the website, realinvestmentadvice.com. But we talked about this ascending wedge where you have rising bottoms and you kind of have flat tops. And so the price is getting compressed between these two lines, this line of support and this line of resistance. And so eventually the market's going to break out one way or the other outside of that range. And it's either going to be the upside or the downside. Which way that's going to break out, well, we have yet to find out. But right now, the action remains fairly bullish. So there doesn't seem to be a tremendous amount of risk to investors in the short term. And corrections have been relatively mild this year. We've had a couple of corrections along the way, as would be expected. As we've noted before, every year you're going to have a 5 to a 10% correction. Well, we had a 5%. And an 8.5% and a 4%. So we've had multiple corrections along the way here. But Brad, I want to show this one chart. But despite that, I just want to show you this one chart. This chart popped out to me this morning. I was posting some stuff up on our Twitter account this morning. The dark blue line is the current market year. And I'm going to make Brent feel really old here. So this was on the Daily Shot this morning. All the other gray lines are every other year. This is year-to-date returns. And so every other year is in the gray line. And this goes back to the year 2000. This is the strongest year-to-date performance of any year since the turn of the century. You have to go back to the late 1900s to find a stronger return year than this one. So the point that I want to make here is that in order to have a sustained trending market like we have now, you have to have the participation of financials and big tech stocks. And that's what you have going on right now. So what, and again, this is all occurring. Right now, the market's been kind of stalled because we don't have buybacks going on. But next week, really starting on Friday, so we've got some important stuff going on this week. We've got CPI this week. I posted out this morning, there are multiple sources that are all suggesting that core inflation will come in at a slightly cooler rate of 0.26%. We'll see how accurate that is, but that's expected to be core right now. So a cooler print on inflation, if it comes in at 0.21, whatever, you're going to have a decent response from the markets. We've got earnings starting on Friday with the major banks. Next week, we get heavy into earnings. The following week is all the big mega caps. So that's Apple, Google, Tesla, all those guys. So over the next 3 weeks, you're going to get support, theoretically, from earnings as well for the markets. That should help keep markets kind of somewhat elevated here. And then buybacks come back in at the end of the month, and we get the year-end rally between post-election and the end of the year. So also depending on outcome of the election. Is there certainly downside risk here? Yes, there's certainly downside risk, but most likely because of the breadth of the market and what's happening right now, any downside risk is going to be fairly contained to current moving averages, probably the 20 to 50-day moving average. So, any correction of 3 to 5% that happens between now and the end of the year is likely going to be a buyable opportunity, at least for now. Now, once we get into next year, all bets are off. Have no idea kind of what's going to happen there. But, right now the pathway seems fairly clear that this market's going to end about where it is right now or a bit higher. Again, there is a technical, if we break out to the upside of this current consolidating pattern that we have, that would set targets for the year end at about 6,000 for the S&P. So there is room for the markets to go higher, but we've had a big return this year. The market is up 54% in 2 years and 61% since the bull market began in October, on basically call it November the 1st of 2022. So we've had a huge return in just 2 years, 25% annualized. That's really, really strong, right? So, I mean, this has been a quite phenomenally strong bull market. And this all comes in the absence of, a big liquidity injection, right? So we don't have zero rates. We don't have, the Fed doing QE. In fact, we have the opposite. We have high rates. We have the Fed doing QT, reducing liquidity to the markets. And yet markets are having an exceptionally strong rally. Again, this is all a function of all the other, while we don't have Fed liquidity, we have a lot of other monetary liquidity. Now, the question is what happens next? Because that liquidity is ending. It is starting to flow out. And, next year becomes an entirely different story. So anyway, just something to think about this morning. Danny, how are you?
Doing great.
Good. Any comments on that before we move on?
Well, I think it's interesting, looking at the numbers that you shared. And unfortunately, with broad market participation that we have not seen, I don't think many people experienced exactly that. So it's a bit frustrating. Unless you were in QQQ or those mega cap companies, your portfolio, if you were diversified, likely underperformed a bit. And then throw in, if you had any bond exposure, that's been a difficult scenario, with the exception of this year. And I've even heard the frustrations over the last couple of weeks with rates jumping the way they have. Now, where does it become problematic if rates get too high? What is that magic number? Is it 4.5? If we get back to that range?
Well, we saw it at 5, pretty much everything stalled.
Yeah.
Right. So And this is one of the challenges. There's been a lot. I've been getting just a ton of emails from people, with videos of people going, "Oh, interest rates are going back to 5, 6, 7%, whatever," and literally, it's great. And all their thesis is, lack the underlying, fundamentals. It's more of just, I think it's going up because it's just going up. The Fed says they're not going back to zero. The Fed says a lot of things that don't turn out to be true, by the way.
Most things.
Yeah. So just because they say we don't want to go back to zero doesn't mean they won't go back to zero, because they will at some point. If you have an economic recession, et cetera, they'll be at zero before you know it. But in theory, there's a lot of reasons you can throw out there why interest rates are going to go up, but just the simple reality of the debt. And I don't mean debt as in terms of the national debt, right? Everybody focuses on the national debt, and that's fine. It's $35 trillion. And yes, we've got interest payments that are making up a larger percentage of our mandatory budget, et cetera. And those are certainly problematic, and certainly something the government doesn't want. They're going to want interest rates to come down to reduce that interest expense on the books. But what I'm talking about is the debt for households, the debt for corporations, the debts for the 40% of the zombie companies that are in the Russell 2000, those small and mid-sized businesses. Just as I was talking about with the NFIB small business report came out yesterday, their big concern right now, interest rates are cutting back on CapEx because they can't afford to borrow the money. The money rate that they borrow at is at 8%. That's way too high for them. Some of the highest levels they've had since the turn of the century, Brent. So that's impairing their business. And at some point, they either go out of business or they have to start making other decisions about what they're doing in the economy, which means, laying off employment, cutting back on expenditures. That slows economic growth. And that's that lack of demand. And this is the thing that people forget, Danny, is that interest rates are set not by some magical wizard on the hill. It's set by supply and demand for loans. If there's no demand for loans, interest rates come down because why? Banks want to loan money. That's how banks make money, is by lending money. And in order to lend money, they have to have a willing borrower. And if they have to have a willing borrower, they have to say, well, I'll lower the rate I'll loan you the money at so I can loan you money, right? So interest rates are determined by supply and demand within the economy for loans. And if there's economic pressure, there's no demand for loans. It's just that simple, folks.
Well, when you break it down like that.
Got me off on a rant this morning already. I'm only halfway into a cup of coffee.
Oh, man.
All right.
Well, we can give you a little bit more time. So what you talk about the supply and demand aspect of this. We just had a Fed auction. Treasuries didn't go over very well. Rates are beginning to creep back up. That's probably a testament to that, that demand aspect to it. Are we about to break out? Because you're talking about technicals from the market. So we've been talking about how we believe there could be volatility leading up to the election. And then all the things you mentioned, share buybacks, we get that window back open. We get a little bit more clarity. I feel like right now, a lot of people are kind of, they're the wait and see approach. And we've seen this a lot with, talking to our advisors. A lot of prospects, for instance, have said, we're going to wait and see before we do anything. Let's talk about that on the other side.
All right. We'll talk about that. All right. Everybody's wondering where Danny is. He was not abducted by aliens. He's here.
I am here. I was not here Friday.
But it's not here Friday. All right. We'll be back. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Medicare open enrollment starts October 15th. If you need Medicare insurance coverage, RIA Advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the insurance tab at realinvestmentadvice.com today. Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
A new study has come out showing that people who take their coffee black are more likely to exhibit psychopathic traits, and people who order a quad shot non-fat vanilla soy extra foam light whip with caramel drizzle are more likely to be their victims.
The Real Investment Show podcast.
I think it's all the same bag of coffee that they just put in different K-cups and labels because it all tastes the same.
Same show, your schedule.
And I think people that go, oh yeah, I can tell the difference between coffees, I think you're completely full of BS.
At realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So, about 10 years ago, I guess, no, it's not quite, about 8 years ago, I bought this speaker. We had a media room, and so I bought this speaker. It's a Martin Logan subwoofer for the media room, and they don't make them anymore. And so it needed repairs, and I found a place in Florida to ship it to, and so I put it.
Oh, geez.
Now, mind you, the speaker weighs about 130 pounds. So I put it inside of a box. I put that box inside of another box. Inside the box with the speaker, I surrounded the speaker with styrofoam, bubble wrap, you name it. I mean, this thing was packed in extremely tightly so it would survive the trip. I went to UPS. I insured the speaker for its value because you cannot replace these speakers. And I shipped it off to Florida. I got pictures from Florida when the speaker arrived, and it was in 12 pieces. The box looks like they had literally just thrown this box off the side of a building. The box was all crushed in on the sides. I mean, just, exceptionally And of course, the box is marked fragile, the whole 9 yards. You know, the amount of abuse this box took was beyond imaginable. And so I submitted my claim to UPS. UPS simply writes me back and says, we're denying your claim because you didn't ship it in the UPS approved box. I bought the boxes from UPS. So, but this is just the way it works, right? And so now I've resubmitted and like no response. Now they're just not even responding. You know, we've denied your claim and we're doing. And of course, they never showed up. They never inspected the box, the speaker, or anything else. That's all being held in Florida and in storage right now for inspection. But apparently, it's not worth spending the money to insure something because UPS is not going to pay you for it. So very frustrating.
Customer service these days.
I know. So anyway, that's
so
my rant
needless to
this
say,
morning.
you no longer have a Martin Logan subwoofer.
No. And again, like I said, you know, I've been on eBay trying to find a replacement, and you cannot find. If you own one, nobody's selling them because you can't buy one.
Well, you know what's going to happen.
What?
It's going to just float away this week.
Yeah, no, it'll be done. So it's actually in Tampa.
Oh,
It's where it's at.
You'll never see it again.
Yeah, well, there's nothing to do for it now. I mean, it cannot be. It cannot be. Even the repair shop said we can normally repair stuff. We can't repair this. It is too far
fragmented.
Yeah,
that's ridiculous.
So, yeah. Anyway, that's my rant this morning.
Sounds like your day got off pretty good.
I overslept and got bad news from UPS. Anyway. So, all right. So one of the things we're talking about is, of course, this rise in interest rates, you know, is certainly it's and again, everybody's kind of got PTSD from when interest rates went up last year. And so it was like, oh my God, rates are going back up again. We're, you know, and then so they're kind of going back into that whole PTSD type, you know, reaction. Look, nothing goes straight up in price. Nothing goes straight down in price. Right? Things are going to vacillate back and forth. And that's a stock, it's bonds, it's commodities, it's gold. It doesn't matter what it is. Everything moves up and down in price. And so, you know, if you're looking to buy or sell something, you know, wait for opportunities. And so if you've been looking to buy bonds, you're now getting a decent opportunity. We're not there yet. I think we got a little bit more work to do. We've got a, you know, bond auction. You know, all the bond auctions are coming up. And by the way, one of the reasons that rates have been moving up is that bond traders short bonds going into auction to bring down the price. They also work in their advantage so they can buy things cheaper for their books. So we have bond auctions coming up. That's going to be another telltale. But I think we have a little bit more work to do. But this is, you know, the you know, part that we have to go back to as well is talking about duration in terms of your time frame. If you're trading bonds and you're thinking, I just want to buy it and make some money with it and I'm out, then yeah, look for opportunities like this. You buy them, you trade the swing, and you're out. If you're a longer term, if you're buying bonds as a hedge for a portfolio for, you know, long-term income returns, those type of things, why would you not want to buy bonds at 4% and lock in 4% for, you know, 10 years, right? That's 4% of your, if your annual return goal is 6% a year, I can lock in 50%. I'm just throwing out easy numbers, right? If 50% of my portfolio is in 4% bonds, there's 2% of my 6% needs already locked up in my portfolio. Now my equity portfolio only has to generate 4% a year. It's easy to build a portfolio that generates a 2% dividend yield. That's super easy. So there's 2%, right? So that's another 1% on 50% of the portfolio. So there's 3 of my 6 right there. So now my equities only have to generate 6% growth to get my other 3%. So there's my 6% annualized rate of return with very low risk. I don't have to take a lot of volatility risk. I don't have to go stretch out on the risk curve to do that. I don't have to take on more aggressive positioning. You know, so you have to think about your portfolio in terms of the rate of return that you want and all this other stuff that you worry about, the election, the debt, this thing and the other thing. It's irrelevant. Those are just things that impact emotion. So, but if you're trading, right? If your whole purpose is to trade your portfolio and you're trading it from day to day, then the election and all this matters, right? That's why we cover technicals in the mornings. Those matter short term. Long term, if you're a long-term investor, what you're looking for is how do I build the return I want over time and take advantage of what the market gives you? And then don't worry about the other stuff.
Yeah, but all those numbers you shared now, that's not what most people benchmark their portfolios towards.
I understand that. And that's the problem.
Well, the problem is that we always want more, and which is great, right? I mean, we have a year in the markets like we've had. We want to participate. We want to do well. We historically do a good job with that, even though 99% of our clients are not 100% equities.
Right.
The majority of them hold fixed income. And so we face that struggle as well as what is that magic blend? Also knowing what is the hurdle rate. So if you don't have a plan, this is where you need to have something that you can benchmark to that's not just the market. What is the rate of return that you need to meet all of your goals and objectives?
Right.
And that should be what we're shooting for at minimum. Now, I think we do much, much better than that. I mean, many of our clients have done such a great job that, their hurdle rate may be 2, 3, 4%. Now, there are times when maybe we're a little bit underfunded. You may have a little bit higher one. So a couple things need to happen, right? We need to save more while we're working, spend less in retirement, or make more in the market. Problem is, I see many people that, man, I'm a year away from it. I haven't done what I needed to do. I'm going to get super aggressive now. We've got to hit the cover off the ball. It's like, whoa, hang on. So with the amount of money you have, if you want to get a lot more aggressive, let's talk about the risk associated with that. You've been talking about Howard Marks and the volatility versus the actual risk of loss. And for many, when you're in retirement or about to be there, that additional exposure, let's say you're in a buy and hold portfolio and you go down 20, 30, maybe even more. Mm-hmm. Is that life-changing? Very well could be. If you're not working any longer, now you have much less to work off of. So imagine you have $1 million and it goes down 20%. And you were taking a 4 or 5% distribution from that. Let's just call it 4. Mm-hmm. So now that 20% off 800 or that 4% off 800,000 is a lot different off of $1 million.
Right.
Now, on the flip side, if it goes up, let's say you make an additional 10% and it goes up from 1 to 1.2. Is that life-changing? I may give you a little bit more wiggle room. It feels good. But on the flip side, if you miss out and you miss that mark and you ride that down, that could be, we could argue, life-changing. You're changing your lifestyle. You're going back to work. You're picking up a part-time job. You're looking at a number of different things that you may have to do. And so what I would urge you to do is find out what is your hurdle rate. What is it that you're looking to do? And take the emotions out, right? Because we can look at any index and say, wow, this was great. That's where I need to be. Hindsight's 20/20. And just because it's up to date, I mean, you guys see all the disclosures. Go look at a mutual fund, an ETF, any of those disclosures. Past performance is not indicative of future results.
Yeah.
No guarantees, right? So we've got to remember that when we're managing funds and you're looking at these funds, they have a purpose. And it shouldn't be to beat the market every year. That'd be great.
But again, that's exactly what, investors are trained to do by the media and everything else. And again, you should look at, and again, it's interesting right now, right? So we were just talking about earlier is that over the last 2 years, the market's up 54%, right? So a huge return. And so now everybody thinks that's normal. But even if you just look at long-term returns, and then this is what you get from financial advisors. They go, well, the market returns on average, 8% a year. First of all, it doesn't, but on average, you get 8% every single year. Well, if 8% is what you get every single year, then wouldn't that be a more realistic number than trying to get 25% rates of return over the last 2 years? Right. Yeah. But as you pointed out, though, we're never happy. And this is why I've talked about before is, comparison is never enough. And, comparison is Wall Street wants you to compare because Wall Street wants you to be unhappy about your returns because
it wants money in motion.
Right. Money in motion creates fees. And so that's why we give you all these benchmarks to compare to. And there's always a new benchmark of some sort. And, here's a new product that will, do better than this. And now we have buffered ETFs and all these other things that are coming out because there's a lot of demand for these products. You have more and more derivative-driven products. Derivative-driven products have boomed over the last 4 years, ever since the stimulus checks and everything else. And so now everybody's piling into levered products on top of this. Now, what could possibly go wrong with this?
Oh, nothing.
Right? But when we come back from the break, Danny, I think, one of the things that we continue to see is people, trying to, well, the election's coming up. There's risk. There's this. There's that. So I'm just going to sit tight. I'm not going to do anything until I know better what's going to happen. We'll talk about the consequences and how to deal with that when we come back from the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Medicare open enrollment starts October 15th. If you need Medicare insurance coverage, RIA Advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the Insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show. Danny Ratliff joining me this morning. So, just real quick to kind of finish up our conversation. One of the things that I'm seeing a lot of right now is, there's a lot of uncertainty. Absolutely. Rates are coming back up. Markets have been struggling here over the last, really kind of couple of months. And so he was like, well, I'm really worried about the upcoming election. So, I'm just not going to do anything right now. I don't want to do anything until after the election. And after the election, once I know the outcome of that, then I can then make some decisions about what to do next. That's a huge mistake. Now, because the reason is that after the election, if you don't like the outcome of the election, no matter which candidate you're rooting for, if you don't like the outcome of the election, then you're going to come up with a whole nother set of reasons not to invest because that person is going to implement some rule or law or whatever it is that's going to be terrible for the markets. And when that doesn't happen and the markets go up, then you're going to say, well, now the markets have gone up too much, so now I can't get in. And so what happens is you get yourself into this whole loop of trying to rationalize why you shouldn't invest. And, it's interesting because it was talked about before, and I just got and we were talking about this on the show yesterday. I still get emails from people that have been out of the market since the financial crisis, right? And this is the mental loop they're caught in. Markets are too overvalued. There's this going on. There's that's going on. This is all going to lead to a crash, and then the markets just kind of keep going higher. So, even if you don't invest today because you're worried about the election, you should be preparing for the election. Say, okay, once the election is done on November the 5th, on November the 6th, I'm putting my money to work. And I've got two plans. If Trump wins, I'm going to invest in these sectors. And we just wrote this. We have an article on our website that we just wrote talking about areas of the market that should benefit depending on which candidate wins the election. If Harris wins, there's going to be opportunity there. You need to have a plan in place so that you say, okay, regardless of who wins, whether I like it or not, I'm going to invest my money based on this. Be proactive. Start making plans. I wouldn't wait till after the election. I would be investing my money now, and particularly as we start to go through kind of the next month of getting into earnings, see how markets are performing. I don't mean put all your money to work today, but as a manager, you have to make the decision to start investing, right? So that's today. But if you want to wait till after the election, that's fine. But you need to have a plan so that you don't get yourself into this loop of constantly talking yourself out of it. It's easy to talk yourself out of not investing, right? That's easy. It's much more difficult to talk yourself into investing because now you have to accept that risk that you may be wrong. And that's part of the investing game. You've got to be willing to accept that risk that you were wrong in your decision and that there's loss, but then you can hedge that, right? So, Danny.
I think the problem is like if we sat down today and really we could sit down at any given time and we could create a pros and cons list. That cons list will almost always be longer. We can always find a reason not to do something. And, and I'm a big fan of that. I'm a big fan of sitting down and say, okay, what are the reasons to do this? What are the reasons not to? But then we've got to start thinking about the parameters. What are we trying to accomplish? What type of risk are you willing to take? And unfortunately, there's many people out there who don't make money in the markets because they bring the emotional side into it and they forget about, what actually is going on. And it's difficult. I get it because we talk about this often, how long the market can remain irrational compared to what we believe it should be or what we believe is rational. And so as Lance is mentioning, we get a lot of people that call in or that email and say, hey, we've been out. What do we do? How do we get back in? And it may be different for everybody. But the bigger theme is, we are a business. I talk to our advisors on a regular basis. And right now we're hearing from a lot of people that are saying, I'm invested. I'm not going to make any moves, or I'm in cash. I'm going to wait until after the election. And as Lance is saying, that becomes troublesome in the aspect of how do you logistically get there? Do you have the intestinal fortitude to be saying, okay, you know what? It's not what I thought. It's not what I like, but there's still going to be opportunities out there. I mean, regardless of whatever candidate you may or may not like, or you may not like either of them. I hear many of you on the chat saying that. That's fine. But is the economy going away? Is the market done for? I mean, we can make a lot of arguments that it's expensive, yes, but it's been like that for a long period of time. We can make arguments that, we haven't seen that broad participation like we like in the market, but that could change. Indexes could be down because the mega caps and other areas could do well. There's always going to be some type of opportunity. Also, we can make an argument for bonds. I know right now, many of you don't like them as we've seen the rates jump around quite a bit. We're seeing them back up, but I still think long term, or even if you're a trader, as Lance was just mentioning, there's opportunity there. There's going to continue to be opportunities. Now, we do have to be mindful that there is potential for larger corrections. Now, is that today? Is that tomorrow? I don't know. I don't think so. But I do know that at some point you're going to have some type of discipline to say, how do we protect ourselves? And so for those that are out there saying, I'm going to wait to make any decision until after the election, you may be too late. You're behind the curve, where you need to be able to have something set up, a plan in place, and say, okay, here's what we're going to do. And that can change, and that's okay. But to just sit back and wait, like Lance was saying, there's many people who, when Obama got elected, has said, I'm out. I'm not doing this. But it didn't matter who was elected. I mean, we can make an argument regardless of which side of the aisle you sit on. He was probably one of the most unfriendly business administrations out there. Lots of red tape, lots of regulations, yet the market did very well. And why? I mean, some of it was a function of what he inherited. I mean, we just got out of 2008, right? Prices were extremely discounted. And so from there, we should have the wind at our back, not to mention, monetary fiscal policy, lots of stimulus that was out there. Trump, kind of the same thing. Biden, right? I mean, we haven't had, now what we have seen now is we're getting more volatility. 2020, a really bad year, obviously pandemic. I don't think anybody can account for that. 22, interest rates going up substantially. Market hated it. We saw, bonds. You're talking about that the market looking back to 2000. You've got to go back to what, 1800?
1787.
And 1788 was the worst year in bonds.
Yeah.
We've got to go all the way back there, but yet that's what we saw in 22.
Which is fascinating to me, right? So bonds have had 3 bad years, right, in a row, which is unprecedented. That's never happened before. And nobody now, and again, this is always the interesting thing to me is that, well, when stocks get really cheap, I'll buy them, right? Or when bonds get really cheap, I'll buy them. But when it actually gets there, you don't want to buy them.
Nobody wants to buy them.
Yeah, exactly. And this is always the problem. This is why people, and again, this is, the reason we tell you these stories about and remind you of these stories about people being out of the markets for a long time, because this is that psychological trap that we get ourselves into. And right now, we talk to a lot of people that are going, well, I'll just wait till after the election, right? Well, they've already been waiting all year. Now they're going to wait till after the election. And what are you going to wait for next, right? Well, I'll wait till the end of the year and see how that's going to go. We'll wait to see, what happens, after the election. There's always a reason to wait. And the problem is the more you wait, the further behind you're getting on growing your assets for retirement. That's the whole point about this. It's not, it's to try to break through those mental hurdles and saying, look, and by the way, investing doesn't mean you have to invest everything you own today, right? That's not what that means. It just means get started. Start doing something to get that money deployed, and then manage the risk and the volatility as you go along. This is why we just talked about risk yesterday. There's an article on our website talking about Howard Marks and examining what risk actually is so that you can help manage that better. We've given you 15 rules to follow to help you manage your own portfolio better if you're doing that. But again, we just have to start thinking about our money. And as I was talking about earlier, think about your return structure and how you want to build out that return. Right? What is the return you want? I want 6%, 5%, 8%, whatever that number is. Pick that number. Forget about the markets. Forget about the data. Forget about economic data. Forget about the media. Focus on that number. And it doesn't matter if the markets are up 20% this year. If you've got your 8% return for the year, great, right? Or whatever your number is. But build your portfolio to generate that return. And that comes from 3 different areas: capital gains, dividend income, and interest income. So build your portfolio to generate that, and you can almost build an annuity out of your portfolio that will just generate returns over time. No, you're not going to beat the market every year. When markets go down, you're not going to go down as much as the market. That's okay. And your portfolio will come down. But even if it comes down in value, you're still generating income from interest and dividends. The growth gives you the adjustment for inflation over time. So in other words, if you can look at your portfolio and say, look, if I had 4% a year to live off of, that's really easy to do right now. 50% in bonds at 4% gives you a 2% annualized income, as we said before, 2% on your dividends. I could even, if you really kind of work, it's not too hard to get to 3% right now. Our dividend equity model at SimpleVisor has a 3%, above 3% yield on it. So, if I can build in the majority of my living stream, my 4% a year, just in dividends and interest, my portfolio doesn't have to work very hard on the capital gain side. And if we do have a downturn in the markets, I can survive that.
Yeah, I think it's putting it all in perspective, and just kind of sometimes we just have to get out of our own way.
Yeah.
So many times it's, we think about the losses, and while we are very, very mindful of that and we want to protect and mitigate the best we can, we also know that, if that's all we ever thought about, we'd never get off of pause, right? You just be stuck.
Yeah.
So have a plan. Understand what you need to do to get to your goals and try to execute. But take this political and emotional side out of it, and I think you're going to be much better off.
There you go. All right. Wraps up the show for today. Be back tomorrow with Michael Leibowitz. We have a good bit to catch up on. We've had just a ton of Fed speakers over the last couple of weeks. So we'll catch up on all that is Fed tomorrow with Michael Leibowitz. Have a great day. See you then.